Money. Money.
In economic news, initial job claims, which measures individual filing for unemployment benefits for the first time, was reported at 234,000 for last week. This was an improvement of 25,000 from the previous report, which was revised higher slightly after the 259,000. The landscape remains the same. Employers are hopeful for faster growth and are holding on to their employees, while at the same time it's getting tougher to add more qualified workers. Now, the ADP report showed that there were 263,000 jobs created in the private sector in March, which was well above expectations of 170,000. Last month's figures, however, was revised significantly lower by 53,000 from 298,000 to 245,000. Now, if you look deeper into the report, there were big gains in construction jobs as they grew by 49,000. Manufacturing was also strong, posting gains of 30,000. And even though the ADP and the BLS do not always collaborate month to month, they have trended closely over the past several months and point a very strong job growth. Now, there was important housing news. The CoreLogic Home Price Index showed that home prices appreciated by 1% in February and 7% year over year. This is a slight improvement from last month's 6.9%. And shows once again the home prices gains remain very strong. Now, CoreLogic also forecasts that home prices will rise by 4.7% in the year going forward, and they are usually a bit on the conservative side. This is obviously national news, much better here in our local market, which we'll get into a little bit later. And also, I wanted to update you on the Fed minutes from the Fed meeting address of the Fed's balance sheet and their reinvestments of their current mortgage bond holdings. Most Fed members said that the change to their reinvestment policy should occur later this year. In particular, they said that the reductions in the Fed's holdings should be gradual and predictable and accomplished primary by phasing out reinvestments in principal received to their holdings. It is unclear whether they want to stop reinvesting all at once or gradually into it. Their balance sheet has $4 trillion that they're holding and $1.7 trillion of which are mortgage-backed securities. They want to eventually let them run off, and they would like to get the mortgage portion of their balance sheet first. And if they do allow them to run off or sell them, it could be very disruptive because the Fed is still buying $4 to $7 billion per week on an average for reinvestments. Now, this has been supporting mortgage bonds, and if they decide to stop doing this, it takes a big buyer out of the market. And if this happens, it will put pressure on the bonds, lowering the value. And as you know, you've heard me mention before, mortgage rates are directly tied to how the bond market, Fannie Mae 30-year bond is trading. So interest rates in that case would increase. Now, New York Fed president and voting member William Dudley said, if we start to normalize the balance sheet, that's a substitute for short-term hikes. Now, if we might actually decide at the same time to take a little pause in terms of raising short-term interest rates, Fed president and voting member Patrick Harker said that they may start the shrinking process possibly by the end of the year or beginning of next year, which would be an appropriate time. An interesting point regarding the Fed and their balance sheet is that if the Fed's only hike the meeting with the press conference in June, September, and December are the remaining meetings this year with the press conference, and the Fed wants to let their bond holdings run off by the end, the Fed should hike both June and September so they can switch their focus, and we'll just have to see how that plays out. And that's my money chat for today. Coming up next on the Money Hour, market updates and how to select a winning agent for your real estate needs. Elisa Skoklin and Carrie Dutton with Keller Williams Realty in Bellevue, right here on 1150 AM KKNW after this short break.